Welcome back. As you can see, we've had a major shakeup when it comes to the rankings of states that are best to retire in. I was quite surprised to see New Hampshire taking the number one spot. Live free or die is their motto, if you've ever seen a New Hampshire license plate. But we would be thinking it would be Florida, right? We're going to dive into the factors that have led to this sea change in the most desirable areas to retire. Bankrate notes that New Hampshire was rated number one for rating well and neighborhood safety. First in that, healthcare fifth, and taxes sixth, and of people having a similar age. So you're seeing folks that are close to your age in that state. And 4 of the top 10 states for retirees are in the Northeast, in New England. We have Maine, New Hampshire, Rhode Island, and Vermont. Louisiana came in at the very bottom, and we're going to see exactly why that happened. So let's look a little bit deeper. It says that Bankrate's list of top retirement destinations and those you may not want to move to looks at data points for each state that we just cited. We're looking at the rankings in crime and livability and also healthcare. But here are the weighted results. So affordability accounted for 28% of the results, and followed by weather, neighborhood safety, healthcare, local taxes, arts and entertainment, or what we would call culture, and then people being of a similar age. But affordability is really one of the key issues for retirees, and why the state of Florida just slipped heavily. And also we had another major sunny state slip toward the bottom of the rankings as well. We'll get to that in just a moment. But it says that retirees and pre-retirees should take notice of these rankings because they look beyond the typical categories and more important factors such as lifestyle and risk factors when it comes to crime, and also the availability of healthcare. So here are Bankrate's ratings of the best places to retire. Of course, we just mentioned New Hampshire's at the top of the pack, and then we have Maine, Wyoming, Vermont, and Idaho. So 3 of the 5 are in the Northeast. But the worst states to retire in, Louisiana came in last place, and we had Texas, Oklahoma, Arkansas, and Nebraska. So I've created a map with the rankings from Bankrate, pulling that data in, and we see kind of a concentration in the Northeast, and then also we kick out to the west for Idaho and Wyoming. And of course we have Utah, which is a very clean state. But then look at the bottom rankings, and one of the things that shocked me was to see that Florida had fallen so quickly. Again, we have exploding homeowners insurance premiums and property taxes and natural disasters. Nevada is down on the bottom of the pack, but California has slipped to 46th, and we can see the other states as well. What's surprising about this map is that the Sun Belt used to be one of the most desirable areas to retire, but that has completely flipped, and folks are saying, you know what, we've had enough of the skyrocketing homeowners insurance and other insurance premiums and the unpredictable weather, and especially hurricanes, and they're saying, hey, we're out of here, we're going back up to the Northeast. So the Northeast is in fact leading the pack. So what does this mean for retirees and those older homeowners that you're meeting with? Well, we can see that the retirement equation has certainly changed, and it's not just about warm weather or avoiding state income taxes to make your retirement dollars stretch further. In fact, in just the last year or two, we've seen many retirees who moved from the northeastern seaboard, those concentration of states we see on the upper right of the map, going down to Florida. And they did that so they could stretch their retirement dollars just a little bit further because Florida doesn't have a state income tax. But what they didn't account for were skyrocketing homeowners insurance premiums due to the hurricanes and natural disasters in that state. And also they have really high property taxes because home values had been exploding in the state of Florida. That may be changing. We'll be addressing that in a future episode, but that's the states that you can see that are becoming more desirable and less desirable. Perhaps it'll help shape a conversation that you have with a client who is looking to relocate. More Gen Xers are postponing their retirement, reports Money Talk News. We're going to get into the details. But Gen X is my generation. It's those born between the years of 1965 and 1980. So why are Gen Xers deciding to push retirement down a few years. Well, nearly a quarter of those that are 50 and older are postponing their retirement plans, and it's up significantly, 14% from the previous years. There's a lot of anxiety when it comes to the economy and whether they have enough stashed away to weather their retirement years and not run out of money. That according to an annual survey from F&G Annuities and Life. Postponing retirement is not just a choice, it's a necessity. According to a study from Prudential Financial Research, it shows that 55-year-olds have a median savings of just about $50,000. And that, of course, is not significant enough to weather one's retirement years. It might get you through 1 or 2 years, but that's about it. Another reason that Gen Xers are postponing retirement is really a convergence of financial crises that they've had to face. Let's think about that for just a moment. First was the dot-com bubble that burst in 1999-2000. Then that was followed by the great housing and economic crisis of 2008 and 9, which we really didn't recover from or begin to until late 2011, early 2012. Now we're sitting here with record unaffordability. We went through some serious inflation here in the U.S. During and after the pandemic, and then we have economic uncertainty for a number of reasons. So those concerns are also pushing many of those that are in my generation and many of your generation, Gen X, to push retirement down the road. Also, many Gen Xers are simply not prepared to fund their non-working years. Studies show that only about 28 to 40% of that generation is on track for a secure retirement. And unlike younger generations who have increasing rents or recent buyers facing high interest rates or wanting to purchase a home, a large number of Gen Xers, and this could be their saving grace, purchased homes even a decade or many decades ago and are now sitting on a mountain of home equity. Now, this may allow them to convert a portion of their home's value into tax-free cash flow or a HECM line of credit without having to sell their home or downsize. And that can help bridge the gap between full retirement or delaying drawing Social Security so you can maximize your benefits. But then there's another advantage to Generation X. We are just right on the cusp of being qualified for a reverse mortgage, whether it's the federally insured reverse mortgage or private or proprietary reverse mortgages, which are offered to those who are 55 or older. But all hope is not lost for Generation X. They can, in fact, take advantage of catch-up provisions. That is where one can contribute an extra $7,500 a year to their 401k or an extra $1,000 a year to their IRA. That's allowed by the IRS, and those contributions can add up when compounded by returns in the future. Bankrate concludes saying that Gen Xers should consider a more flexible retirement timeline. In other words, don't get fixated on a certain age. Also, to seek the advice of a qualified financial professional who can run several scenarios or may be able to help you get a long-term care insurance policy. Yes, they're still affordable for many in their 50s or even 60s. So those are some of the steps that they can take. But to do that, you have to know your income, what are your debts, get a better grasp of your overall financial picture. But Gen X is, in fact, the next generation for reverse mortgage lending. And be sure to go to HECMWorld.com because there we have a column on that very topic. I think you'll enjoy it very much. But Gen Xers, they're having to postpone retirement, and as a Gen Xer myself, I am not surprised. And John McHugh returns with Reverse Market Insight for our monthly segment of the Reverse Market Insight Market Minute. And even better, there has been a recent release of a tranche of HECM data from HUD. It had been backlogged for months, so we're glad to see that, and John's going to explain just what all of those data points mean. But before we dive in, I want to say be sure to check out the neighborhood widget. You can see it here in action. You can add it to your websites. If it's with us, you can do that very easily. We hope your website's with us or any other website. It allows your website visitors to see just how many reverse mortgages have been done in their area. But John, thank you for joining us. Tell us a little bit more about this recent tranche of data.
Hey, thanks, Shan, for having me back again this month. Really appreciate it, and got some good news HUD actually updated a bunch of data. We went from February data only all the way through May. So it looks like, with a little luck, we might be back on track with regular updates. So that's fantastic. It's been a big relief. And kind of helps give us a little more insight into what is going on and what has been going on. So let's go through case numbers here. Last set of case numbers we had is through February. So we have 3 more months of data here, which is fantastic. When we look at the November 24 through February 25, case numbers have been hovering right around 3,000, just under 3,000, someplace in there. So in March, we really saw some real improvement in the 10-year CMT as the CMT dropped. We saw some real improvements in case number assignments. They actually went up by 16%. In April, they went up another 11% to 3,784, as rates remain low. Then in May, the 10-year decided to start climbing some. So we did see a decrease again in May as the 10-year CMT rose. The case numbers dropped by over 11.5% to 3,370. In June, we saw some improvements in the 10-year CMT, so we'll just see what that does, when the June case numbers come out. But the important thing here is that we have some actual data that we can start looking at, start using as some real forecasting. As we look here, H for P from the start of the year, it's actually been picking up in March, April, and May. So that's always great to see. HECM to HECM refinances, they've also been increasing since the start of the year. So we're seeing some other increases in other places besides just the new equity takeout. But at the end of the day, we've been seeing some increases here, which should hopefully drive better endorsement numbers going forward. As we look, and we were just talking about this, the 10-year CMT. This is just a kind of a monthly average of the CMT. So we can see from the start of the year it was much higher. In March through April, it was flat. In May, it went up, and coming here into June, it's been it was going down. So this the good thing is it hasn't risen sharply. It's coming down some. Kind of a roller coaster. But the important thing is that this has kind of been setting us into this kind of a new normal, and we'll talk about that in a moment. So June endorsements declined by 2.3% from May to 2,244 loans. The regions were mostly weaker, with just 3 of the 10 increasing. In fact, Northwest Alaska, it grew by 25% to 209 loans. Great Plains rose 12.5% to 45 loans. And Pacific Hawaii, it just barely inched up, just under 1% to 590 loans. The top 10 lenders, they did slightly better than the regions, with 4 rising versus the 3. Fairway gained almost 42% to 95 loans. Mutual was up almost 30% to 544. In fact, it was their highest monthly total since December, so congratulations to them. High Tech was up 14% to 48 loans. Some decent gains here for those companies. The endorsements, numbers, they really seem to have kind of stalled here in this 2,000 range. When we're looking at the HECM product, at least. And so for now, that's kind of the new normal. This 2,000, like 2,200 to about 2,600, someplace in there is kind of where we're teeter-tottering between. This also, I think, just helps prove that the industry, has accepted these new higher rates. Loan officers have figured out ways to make these loans work, and borrowers are moving forward with these loans. I mean, we're just kind of in this new normal. It's also seen in case numbers, this new normal, right? So, I mean, they've moved above 3,000 for the first time this year. Even with the rates moving higher in May, we still were above 3,000. So that's good to see. I would say that in July, there's a good chance that we'll see an increase, just kind of looking where case numbers were. I think we'll see an increase from June's numbers as far as endorsements go, but even an increase still kind of keeps us in that mid 2000 range. So, anyways, we'll see what happens next month. Hopefully, HUD continues to give us this data. It's all, good news as far as that's concerned. We are seeing some positives, even though endorsements are down. We're seeing things kind of shifting in the, in a new normal, consistent pattern that we can, actually kind of rely on. So all good stuff. So we'll talk to you guys next month. Have a great day.